let's be honest for a second. Let's talk about that awful feeling, that frustration of watching your crypto portfolio just go the wrong way. Look, it's probably not about bad luck, and it's definitely not about being smart or not. Today, we're going to dive into the real psychological reasons so many of us struggle. And you'll see it's a journey that reveals a lot more about our own brains than it does about the market. So picture this. A coin is absolutely pumping. It's all over the news, your friends are texting about it, and there's this little voice in your head just screaming, "Get in now or you're going to miss out forever." So you do it. You buy, right at the tippy top of the hype. Sound familiar? Yeah, I thought so. Hey, if you've done this, please do not feel bad about it. This isn't some personal failure. It's actually a totally predictable reaction, thanks to a bunch of powerful, sneaky biases in our brains that affect pretty much everyone. And just understanding what they are, well, that's the first huge step to beating them. So where does this whole roller coaster usually start? Well, it almost always kicks off with one of the most powerful emotions in any market, that good old fear of missing out. You know, FOMO is basically that deep down anxiety that some massive life-changing party is happening and you weren't invited. And the research on this is wild. That feeling can be so intense that it literally hijacks the part of your brain that's supposed to be doing rational long-term thinking. You just stop analyzing risk and start reacting to what everyone else is doing. And this chart right here, this shows us exactly where that feeling hits us like a ton of bricks. We're looking at the classic market psychology cycle. And where do most people jump in? Right here, smack in the middle of the thrill and euphoria phases. I mean, it's that moment when it feels like prices can only go up and everyone is optimistic. It feels like you can't possibly lose. But in reality, it's the absolute point of maximum financial risk. And in the crypto world, this whole effect is just put on steroids. The 24/7 fire hose of social media hype and meme culture creates what the experts call irrational exuberance. It's a crazy feedback loop, right? The hype drives the price up, and the rising price makes the hype seem justified, leading to these valuations that are just completely unhooked from reality. And this isn't just you feeling this alone in your room, no way. It's driven by herd behavior, and it's amplified round the clock on social media. Places like Twitter, Reddit, even TikTok, they can turn into these massive echo chambers, where what the group thinks totally replaces your own analysis. When you see thousands of people all piling into the same coin, it feels like it must be the right move, even when it's absolutely not. Okay, so you bought in. And hey, maybe you even caught a piece of the upside. Your portfolio is looking nice and green. But this is the point where a new and honestly, an even more dangerous bias starts to take over. It's our brain's tendency to believe we're just better at this than we really are. This bias is what leads investors to trade way too often, take on way too much risk, and just completely forget the role that pure luck is playing in their wins. Now get this, studies have shown that over 80% of investors rate their own skill as above average, which of course is statistically impossible. It just goes to show you how deep-seated and how common this overconfidence thing really is. And here's the crucial thing to remember. In a bull market, when everything is going up, it is so easy to feel like a genius. This is the Dunning-Kruger effect in action. A little bit of success creates this huge, often totally unearned dose of confidence. You start thinking you've cracked the code, when really you were just on a rising tide that was lifting all boats. But as we all know, the market inevitably turns. That beautiful green portfolio starts to bleed red. And now, a completely different and very powerful psychological force takes control. This is one of the most fundamental ideas in all of behavioral finance. Our brains are literally hardwired to avoid pain, and the psychological sting of losing money is so much more powerful than the joy of making it. And this bias makes us do some seriously irrational things just to avoid facing a loss. Let's make this super simple. Imagine you make $1,000. Feels pretty good, right? Okay, now imagine you lose $1,000. According to all the research, that feeling of pain, that punch in the gut, is more than twice as intense as the pleasure you got from the gain. And that imbalance completely warps our judgment when our investments are down. And if we go back to our chart, you can see this playing out perfectly. As the market starts to dip, we enter anxiety, and then we slide right into denial. We just cling to those losing positions, telling ourselves, oh, it'll bounce back. Not because it's a smart strategy, but because selling would mean we have to admit that the loss is real. And that hurts. But you can only hang on in denial for so long. As the losses keep piling up, that emotional pressure just builds and builds, and it leads to the dramatic final act of this whole cycle. Capitulation, it's not just selling, it is total surrender. It's that point where the fear and the pain get so extreme that investors just sell, all at once. It's not a strategy, it's just a desperate attempt to make the pain stop.
And that is the absolute key here. Selling at the bottom is almost never a logical, calculated decision. It's a pure gut reaction. Fear has completely taken the wheel, and your main goal isn't to make money anymore, it's just to stop the bleeding. So here we are on the chart at the absolute rock bottom of the emotional journey. Panic flows into capitulation, which finally gives way to total despair. And here's the brutal irony. This is often the point of maximum financial opportunity, because everything's on sale. But it feels like the point of maximum danger, so we end up panic selling to the very people who are keeping their heads.
Okay, that was pretty painful to go through. FOMO at the top, overconfidence, then loss aversion, and finally capitulation at the bottom. The big question is, how in the world do we break out of this loop? Well, the very first step is just seeing this pattern for what it is. This whole emotional roller coaster. It's predictable. Those intense feelings of euphoria and despair, they are not unique to you. They are baked right into the DNA of market cycles. And this diagram here, it really ties everything together. All those individual biases we just talked about, that investor sentiment, the overconfidence, the loss aversion, the herd mentality, those are the direct inputs. And what are the outputs? Market volatility, bubbles, and crashes. In other words, our collective psychology literally creates the reality of the market. When you really strip it all down, the classic failure pattern is this. You buy high and you sell low. It's not an accident. As one study puts it so perfectly, it's a recurring pattern of buying during euphoria and selling everything during a panic. Look, at the end of the day, you can't control the market. You just can't. But you can learn to control your reactions to it. By understanding these psychological forces, the FOMO, the overconfidence, the loss aversion, you start to build the awareness you need to spot them in yourself, in the moment. Recognizing the pattern is the first, most crucial step. So the real question is, now that you see the game board, can you change how you play?